Tonight, getting into tonight's conversation. So last week we talked about life insurance, but honestly, guys, I left kind of feeling like, man, I really don't know if they got a real good understanding of why we're so excited about the things that you can do through life insurance. And so I think we got a good understanding of why it's important, as far as leaving something great for your children. But I really wanted to really go into what are the things that you can do with your life insurance while you are living. How do you start building generational wealth now? What are things that you can use that for? And so I'm kind of going to do a part two. I would like to preface this by saying I am not a financial advisor. I am not a life insurance broker, okay? Everything that I'm going to talk to you guys about tonight are things that I just researched, okay? So I just researched. So I encourage you, in our wealth building space, we are here trading knowledge, which means, yes, we're going to go through some definitions. We're going to go through some basic information, but I encourage all of you to do your own homework. Go out there and do some research on your own. Once we get done with this call, like go and talk to your own insurance provider and see like, hey, what's going to be the best option for me and what it is that I want to do. Okay. All right. So the first and foremost thing, the reason why I was excited, at least, about learning and sharing with you guys more about life insurance is because a lot of people who are building wealth through life insurance, what they're really doing is changing their mindset and thinking like a bank. Okay, thinking like a bank. And so when we start talking about thinking like a bank, you're thinking about when every dollar that comes in, okay, when money comes in, the first thought is, how can I make money off of that money? All right. When your bank goes into Wells Fargo, it goes into Bank of America, it goes to all these different places. Your your money is making money for the bank. So their thought process is, when Martha puts her money in, when Lakaya puts her money in, when Flo puts her money in, how can I make money off of this money? So when we start thinking like a bank, every dollar that comes in, all right, how can I make another dollar off of this dollar? That's the mentality we want to start having when it comes to wealth building, okay? Also, storing cash for higher interest rates. So always looking for, how can I get the best rate of return for my money? And then lastly, tax-free growth. How do I get to keep more of the money that I have rather than giving it away to the government? So those are the three concepts that we really have to keep in the back of our minds when we start looking at what is possible, okay? Because with a life insurance policy, with the right policy, you have the ability to earn 2 to 3 times for every dollar that you're putting into that policy, okay? You have the ability to use tax-free dollars to invest in other projects and assets. So now we're talking about, again, living off of the interest of our income, right? Remember my mentor who always said, the way to get true financial freedom is when you have the ability to live off of the interest of your money. That's why we're building up our Novatech accounts, right? Because at some point we want to have enough in there where we can literally just live off of the interest of our funds. So this is another way of doing that, all right? And so ultimately, we want to get to a place where we can funnel everything through our wealth creation fund. And that's essentially what you're creating with the right life insurance policy. You are creating a wealth creation fund. You're creating a fund that literally is continuing to bring you interest and earned income every single month, every single year, okay? And so as we look at this, I want us to think about who we have been in the past. I heard a financial advisor break this down. I thought it was really important, so I wanted to share it with you guys as well. And they said, there's 3 types of people out there. And most of us, I think, were taught to be in category 1. I know this is what I was taught, okay? And category 1, those are debtors. What is a debtor? A person who gets in the hole and then you pay to get out, right? You get in the hole, you pay to get out. I get a new job, I get an increase in my income, I get a car, I go get a car, I got in debt to the bank, and now I'm going to pay to get out of debt and get back to zero. Well, most of the time with debtors, they're constantly in that cycle, getting into debt, paying it off, getting back into debt, paying it off, right? And so you're kind of always at zero is kind of the way that he described it. The second group of people are savers, right? So these are people who don't believe in debt, right? I definitely, this was my second way of learning to be. I started, I think actually it was Tasha who was the first person that said, you need to read Dave Ramsey. And so I started listening to Dave Ramsey, and I started getting into the mindset of like, I just wanted to hate debt. I didn't want to have any debt whatsoever. I wanted to just like everything to be, I wanted to pay cash for everything, right? And so when it comes to savers, what happens with a saver is they save up, then they spend, it goes back down, and they have to save up again. All right, so they save up, they spend, they save up again, they spend that, save up again, spend that, right? Nothing against being a saver, okay? I love the idea of being a saver. But the way that he talked about the wealth creators, I think is basically what we are all here to do, right? And that is, with a wealth creator, again, they have the mindset of every dollar that comes in, how can I make more money with that money, right? They also think instead of saving up and then using all of that and coming back down and having to save up again, they think, how do I use other people's money to buy assets that are going to bring me more money? So even if I'm getting out of debt, I'm not paying off the debt necessarily because I'm using other people's assets or other people's money to create assets that are going to bring me more money, which brings me back to zero. So it's a different way to look at it. And especially they're also looking at, how do I always lower taxes? So again, when we start talking about thinking how banks think, which one of these three are more like how the banks think? It's the wealth creators. And so a lot of wealth creators, they actually use their insurance policies to be able to create some of that wealth. So let's look at some examples. And these are just things that I've researched. If any of you guys have also heard some amazing examples of people using their life insurance policies, definitely raise your hand or unmute yourself and tell that story, because I think, you know, when people really understand what's possible, that's when it becomes real for us, right? So I heard one story about a Catholic church that had their older members who were paying tithes. Instead of paying the tithe into the church, they had them pay into an insurance policy that the Catholic Church owned. Okay, so they owned the policy and they had them pay their tithes into the policy. And so when those older members passed away, who got the death benefit for those policies? The church. So it was a way of bringing more money into their church so that the church could take care of their people, right? So instead of over maybe the course of, 5 or 10 years, them making $200,000, they made about $2 million because they got the death benefit for those individuals. Now, can their families also have insurance policies on them? Yes, absolutely. You can take an insurance policy out on anyone. So it didn't take away from their family or anything. So they used the same funds, but it actually created wealth for their community. And I think that's what most of us, what we really want to do. It's not just about, okay, how do I make it come up? We as a community want to come up. So we want to start thinking in terms of that, okay? I've also watched a lot of videos about real estate investors who borrow against their insurance policies to fund their projects. How does that work? So when you're putting in, let's say you have $100,000 in your insurance policy. Now that insurance policy might be for $1 million, but you have $100 that you've built up in cash value, 100,000. If you pull out 50,000, okay, to let's say buy an old house, rehab it, you have 12 months where that money is completely tax-free. All right. So you didn't have to do any kind of credit check, right? Like you would if you had to go to the bank. You didn't have to fill out any paperwork. You didn't have to necessarily pay any interest on it, but you were able to take money out of that fund, fix up this house, resell it, make a profit, pay back your insurance company, and you created wealth for yourself, right? Without having to pay any, fines or interest or anything like that. If you had tried to do the same thing with your 401k, you would actually be penalized for doing that. Okay. I heard of one person who said, do you guys remember last year when GameStop skyrocketed up, like the people became the market makers? They were like, no, we're going to take this thing over, and the people made a lot of money. Where he knew that, hey, they're not going to let that happen for too long. Like the market is not going to let that happen. They're going to go in there and it's going to tank again. And so what he did was, after that happened, what he did was he took, I think he said $100,000 out of his insurance policy. He put it in for an option for a sell. You guys all know what that means. Excuse me. He put in an option for a sell. It sold, okay? He actually earned $300,000, was able to pay that $100,000 back and profited $200,000 without any tax implications. So that's amazing. The Rothschilds and the Rockefellers, I think a lot of people know these stories, but the whole idea of them creating these family trusts, right? And in the family trust, that's where the insurance money goes, okay? So the trust owns the insurance policies. Anytime somebody in the family passes away, that money goes into the trust. And so when family members need money, when they need to start a business or anything, they go before the family trust and they ask for the money. And so they get a loan from the family trust. They're not going out to banks and paying interest rates. They're doing it within the family. And so when that gets paid back, it goes back into the trust. And so every time, someone passes away and there's a payout, the family is getting more and more wealth generationally. Okay. I've heard of people who started businesses, right? One person in particular talked about starting a Turo business. For those of you guys who don't know what Turo business is, that's where you can actually rent out your car. And so there are people who purchase tons of cars, or they may just put down a down payment and they let the business pay the monthly off of that. Okay, so imagine if you took out, $10,000 or $20,000 out of your insurance policy and you put down payments on 2 to 3 cars, and now you've got a Turo business where you're making 10 times the amount that you're paying for your monthly payment every single month off of that Turo business. Okay, so these are some of the things that people are literally doing right now every single day. And the key is we can do the same thing. All we have to do is really know and understand how to do it. So here's a couple of things that you really want to know, okay? So in the research that I did, you cannot do this with any and every policy, all right? Because I'm like, where's the policy? You can't do it with any every policy. There is no such thing as a one-size-fits-all. That's why we have insurance brokers. And so when you sit down with your insurance broker, you actually are going to design a policy based on the things that you want. So here are a couple of keys that you want to know if you want to do some of the things that we've been talking about, okay? Number one, you want to make sure that your policy is written so that you can create cash value fast. That's the main thing, okay? Like even, recently going to the doctor, and the first thing the doctor said is, what's your goal? Like, what's your ultimate goal, so that I can keep that in mind for everything that we're looking at right now. So when you're sitting down and you're looking at what you want to do with this insurance policy, the first thing should be, I want to be able to create cash value fast. The cash value is what gives you the ability to borrow against it, for all of those tax benefits. You also want to have a good tax-free interest rate, a good tax-free interest rate. All right. And so you would want to talk to your provider to talk about different interest rates and see the one that works best. Okay. You want to make sure that it has the ability to grow uninterrupted, even if you're using your funds. So what does that mean? If, for example, the person who took who has 100,000 in cash value, they took out 50,000. If their money is supposed to grow at 5%, meaning the next year they're going to have 105,000 in that account, you want to make sure that that will not be interrupted. So even if I took out the 50,000 to go, do a rehab on a home or something like that, you want to make sure that, hey, in a year, I'm still going to have 105 because it's still being, the interest is based off of the original amount. That's what you want to make sure, okay? And then also making sure that there are no payback penalties as well. All right, so let's look at a couple of different policies as you're starting to think about this, okay? So the first one, I'm not going to spend a whole lot of time with it, because the first thing that they will tell you is that if you want to do the types of things like build wealth through life insurance, term is really not the policy for you. But I did want to touch on it because there are a couple of things. Number one, lower monthly payments. It's for a specific amount of time, 10 years or 20 years. But again, it is not cash building, okay? It's almost like if you can't afford anything else, then get the term. But one thing that they did say is that term insurance is how insurance companies make money, not how people make money. Because on average, only 2 to 3% of term life insurance policies are ever actually cashed in. So just something to think about when we're talking about being on the right side of wealth, okay? Now, what I did think was really cool is that you can actually insure your mortgage with a term life insurance policy. You can insure your mortgage. Now, what does that mean? You can get mortgage insurance. You can get mortgage life insurance. When you get a mortgage life insurance, what that means is if something were to happen to you and you had a mortgage, that life insurance policy would pay off the rest of your mortgage. So it would go to your bank or to your whoever's holding your loan. But if you got a term life insurance on your mortgage, okay, not a mortgage life insurance policy. If you got the term insurance policy, you would still get the same amount for your mortgage, but your beneficiaries could choose how they want to spend it. It would go to them and not to pay off the house. You guys understand what I'm saying? So they might say, well, she's got a 3% interest rate. We can handle that. We can handle paying for the house, but we've got 23% interest on our credit card. We want to take those funds and actually pay off these credit cards or do some other things, right? So that's a pretty cool thing. Now, if your beneficiaries are irresponsible, you might want to just do the regular mortgage, just make sure the house gets paid off, right? But I did think that that was pretty interesting that you can, you have the ability to do that. Okay, the next one is whole life insurance, right? We've all heard about whole life insurance. And so the way that it works is basically, guys, it combines your coverage with a savings account, right? It combines your coverage with savings. So part of that premium that you're paying goes into a high interest bank account or investment account, okay? That's being invested in the market, and that's how they're actually able to pay you better returns. Now, the key with the whole life insurance policy, if you want to do this, do the things that we're talking about, the key is you've got to get the highest amount of cash value for the lowest amount of death benefit. The highest amount of cash value for the lowest amount of death benefit. Why is it important for us to remember that? Because one of the things that I found out as I was going through and researching is that they said your insurer is going to always try to get you to get a higher death benefit. Why? Because they make more commission. But it's actually more beneficial to you to have a higher cash value amount and a lower death benefit. One other thing I wanted to mention too about the example of somebody borrowing against their life insurance policy to do real estate and things like that. If for some reason that person could not pay off that loan, let's say something went bad, they could not pay off that loan, it doesn't go on your credit report or anything like that. What happens is they deduct it from your death benefit. So if you've got $1 million policy, that $50,000 will be taken off of your death benefit, meaning that your heirs would get $950,000. You guys understand what I'm saying? So really, either way, in my opinion, you still win, right? So just something to think about, okay? It can be structured to where you can only where you only have to pay that premium for a certain amount of years. So just because you have a whole life insurance, and a whole life basically is permanent life insurance, you're not permanently paying a premium. There is a set amount of time that you can pay for that, and it's done, all right? But you must pay for it for at least 7 years or more. And why is that important is because it used to be where people could literally put millions of dollars into a life insurance policy to protect it, tax-free benefits, all that stuff. And so then they made laws around that and said, no, it has to be like an actual life insurance where you're paying into it, okay? So you got to pay into it for at least 7 years. You can't just say, oh, I got a lump sum and I'm just going to dump it in there, all right? And then the cool things for those of you guys who would want to start building wealth this way, you can start borrowing against it within 30 days of actually starting that policy. All right, the next one is universal, all right? So the next one is universal. Very, very similar to whole, except you get a higher return on interest usually, okay? Usually there's gonna be a higher interest rate that they give you, and you actually get a little bit more flexibility. So it's also known as an adjustable life insurance, okay? So what that means is that you can actually adjust your benefits. You can actually adjust how much you're paying into that premium. And I do think it is a little bit more expensive. If I read correctly, it is a little bit more expensive to be able to have that flexibility. But for some people, if you're falling on hard times, that actually might be really beneficial to you. This is a longer plan, meaning that you really you can't borrow against it for about 2 to 3 years. So some of you, that might be perfect because you're like, okay, I want to pay into something, and in 2 years, I know I want to be able to start doing these types of things because maybe I have to start small. And this might be the perfect option, okay? And then as your, like I said, when your financial circumstances or responsibilities change, increase or decrease, you can even stop your premium payments when it comes to this type of life insurance, okay? Rather than dividend payments, whole life insurance, you get dividend payments that come out usually annually. These policies are based on the interest rates from the markets that they're being traded in. So why is that important? It's important because that means the interest rates can actually go down. All right, the interest rates go up and down in the same way. Like every week we don't get the same interest rate, same thing. Okay, so just something to take into consideration. Index universal is a variation of the universal life. Okay, just slightly different. The cash component of that policy is linked to the performance of a stock market index. Like yours might be linked to the S&P 500, which you guys know anything that's pretty much linked to the S&P 500 is really good because over the course of the last 20 years, the S&P 500 has had more growth than any other thing. So that's a good thing, okay? The policyholder decides how much cash value is assigned to either that fixed account or the equity index account. So you have a little bit more control there. There is, however, a cap. So if the S&P 500 does 20% for the year, but if your policy says, hey, we only, you get to get up to 12%, you will only get 12%, all right? But still great way to earn. So when you start thinking about how do we use this, the main thing that we've been looking at kind of is borrowing, for your assets. And so again, just wanted to kind of break it down so that you understand your options and what this really gives you. If you were going to go in and borrow for any reason, which most people, what did we say about wealth creators? They're looking for, how do I use other people's money to fund what it is that I'm trying to do to build assets, right? Number one, at the bank, you got to apply, you got to have good credit. It is a structured loan, meaning that you could have paid on time every single month, but you didn't have it all this month. It's going to start to affect your credit. And then also when it comes to the bank, they could actually take your asset. If you are getting a secured loan with the bank for a certain asset that you're purchasing, they can actually take your asset should you fall behind or something like that. With your 401k, again, you're penalized, so your money is pretty much held hostage. It's tax deferred, which we've been taught is a great thing. But when you think about it, you're saying, hey, I'm putting my money in now, and whenever I take it out at 59 or whatever age I'm going to take it out at, I'm going to be taxed on whatever the tax rate is at that time. Is tax rates, are they going up or are they going down? They're always going up. So you're actually going to probably be taxed at a higher tax rate than what the taxes are right now. So there's a lot of things that you got to kind of consider. With your insurance policy, you literally can borrow money tax-free for up to 12 months. After that 12-month period, then there might be an interest rate, but the idea is you want to pay it back before 12 months. You can't be sued for it. Because it's not attached to any asset. There's no structured payments, meaning you don't have to pay it every single month. You basically get to choose, when you're paying this back. It doesn't affect your credit score, even if it does go wrong, And then the default, like I said, can be deducted from your death benefit. All right, it can be deducted from your death benefit. All right, guys. So just a couple of things to think about this week. Just think about, again, how are you building wealth? So as we're all creating our wealth plan, we should be thinking about diversifying, right? Number one. So yes, I know Some of us were thinking last week, man, she's talking about 4% a year. We're getting 4% a week. Yes, but we also want to diversify. We want to have our money in different things. We want to have stocks. We want to have bonds. We're going to be talking about all of those items, all of those different types of investment tools throughout the year. So we want to be diversified, and most of us are probably going to have life insurance anyway. So why not set it up to win? So this week's challenge is to just do some research and look, if you already have a great life insurance policy, look and see if there is anything that maybe you can add, or talk to your life insurance provider about how you can maybe do some of these things. Look and see how much cash value do you have. Look to see, are you in the right policy? I also didn't realize that people had multiple life insurance policies. Like one person said he had 8. I said, oh my gosh, and he had them for different reasons. So just thinking about future planning, what could you do if you had access to the things that we were talking about tonight? Okay, what could you do? All right,